coming in. Oh, I can't hear you yet, I'm afraid.
No, I can't hear you either, Wayne.
No.
I can hear everyone. Can everyone hear me?
Yeah.
Oh, good.
Yeah.
Sorry, I thought it was me as well. No, can't do it. Give me a second.
One, two, 1, 2. Can you hear me?
Yes.
Yes.
Yeah, we can hear.
Hi guys. It's really funny because I don't use this this headset. I take it you can probably see me as well. I don't use this headset normally because my whatever, my computer tends to, the microphone there works, but something, but this one, yeah, this is your old-fashioned thing going on. Good. Hi, how are you? Yeah, there you go. That's technology for you. You never know when it'll decide to hi, Graham. Are you there? Hi, Graham. Are you well?
Yeah, I'm here. How you doing?
I'm well, thank you. Good. Great
Good.
stuff. Good stuff. Awesome. Cool. Yes. This is actually quite good because hopefully you should only be able to hear. Oh, this is actually really good because at 8:20 this morning, this big truck thing with these like 6 guys turned up kind of on the main road to do some scaffolding work, and they're drilling. And I mean, as diplomatic as I can go out there and say, hello chaps, I think this is a bit noisy. I don't think it's going to work because they need to work. So hopefully you should only be able to hear my this should protect you from any external noise. Cool, great stuff. I hope you're all well. How's it going? How's the world of accounting and law and industry and in these very interesting times? How's Kent? How's London? Hannah and
Yes, good, thank you.
settling down all right. Good stuff. Cool. Awesome. Let's carry on. Let's kick off. So we are going into our final chapter, which is on reporting. Again, I actually think what they've done is really interesting here with this chapter. They have, I think, simplified things, which is good for all of us, because it used to have it's still the same thing, and I'll try and explain how it was, even as at the last syllabus, because really the syllabus has changed. Well, and when I say changed, they've just made it a bit more obvious, and a lot of people have kind of been talking about that because that really was it. There's just too much terminology, but now it really is just what it is, and hopefully I'll try and make it as practical as possible, because of course in reality there's so many scenarios given so many industries and the sorts of things that you could have that decide whether or not accounts are true and fair and blah blah blah. So let's go into that. Let's go. So let me just share my screen. Right, yes, great stuff. So hopefully you can see my screen. And I am going to work with the text because I actually think it is very sort of, I'll do some written work where I think I need to, but because a lot of the material is kind of essential, it's what it is, and I'll kind of explain it, but then sort of add anything I need to sort of make things a bit more straightforward. So we're really fundamentally now talking about what happens at the end of the audit. What documents do we actually produce, if you like, for the stakeholders, or the if you like, the users of these documents, of these statements. And that's where we really are. Yeah, I mean, again, if anything, it's tricky using the word interesting with audit. The other day I was on Wednesday I was teaching advanced tax, and I think I'd gone out at the break, like how you have whatever 11 o'clock, and I went into the corridor, and my wife said to me, so how's it going? What are you guys doing? And I said, oh, we're just talking about some elements of and as soon as I said some elements of inheritance tax, she was like, and I'm thinking, sorry, are you actually yawning, or are you yawning? Which one is it? How exciting, how interesting can it be? And I think this can be interesting, this bit. There are interesting elements to it. You could have that kind of argument. Well, I could recognize it as this, and we call it that. And you'll see where I'm going as I kind of take you through this. So ultimately, when I say why I think it's interesting, is because it's an opinion, isn't it? It's an opinion, and I think it's The Guardian that have as their tagline, opinion and informed opinion, about comment is free and informed opinion is gold, or something along those lines. But opinions vary. So I, as an auditor, might go into a place, and you, as an auditor, might go into the place, and we might actually slightly differ on opinions, which is why we have the standards to really try and guide us to arriving at, if you like, an opinion that the stakeholders can trust. Ultimately, is where we're going. So ultimately, the whole purpose of everything we've been doing so far is to form an opinion. And fundamental to that is this trying to gain sufficient and appropriate evidence to then back up that opinion. Ultimately, we're trying to get to the opinion that the accounts are true and fair and free of material misstatement. You're probably looking at all that and just shooting it down, just thinking, oh, and what does true mean? What does fair mean? What does material mean? So it's almost leaving open the scope for my opinion is my opinion and your opinion is yours. But ultimately, we have, and I'll tell you some very clear, I'll say it at the beginning, for academic purposes, your job is to calculate those benchmarks. I kept drumming and drilling 5 to 10% of profit before tax. That's the first one you have to calculate. If it is outside that boundary, it is material. In reality, we could probably not. But for you, if you calculate any figure and it is outside the 5 to 10%, it is material. You have a problem. Of profit before tax. I'll just slip in the next one now, because like I say, it's about drumming in so that you will never forget. 0.5 to 1% of revenue. But the 5 to 10% of profit was fine. You're done. You're okay. You sailed through. But 0.5 to 1% of revenue, if that figure that you're interested in is 0.5 to 1% of revenue, if it's more than that, you have a problem. So to give yourselves good marks, you could kind of calculate both. I don't really know whether we go to total assets. It's rare. It's just a bit. Those are the two things you're looking for. So from an academic purpose, for academic purposes, we can be academic about it. Oh, I'm sorry, it's more than 10% of profit before tax. Or I'm sorry, it's more than 0.5% of revenue. So therefore, that's what it is, and I'm walking away. And everyone's looking at you in reality thinking, well, it doesn't really work like that. That's what the textbooks say. So ultimately, we're trying to form an opinion based on the, again, like I say, the evaluation of, let me just, here we are, based on the, oh, sorry, my pen isn't connected. Let's just get that in there. Let's get this in here, 1 second. Sorry, just plugging in my. Yes, we're trying to. Okay, great. So we're trying to form an opinion on the financial statements based on the evaluation of the conclusion. So that's what ultimately we're trying to do, form this opinion, and of course, put it into a written report. And there is a standard written report that I will take you through here. And again, we're trying to form an opinion in all material respects. What are we really looking at when we talk about, what have I been looking at over the last 2-3 weeks as an auditor? I have been looking at the financial statements. And when I talk about the financial statements, I'm talking about the statement of profit or loss, the statement of financial position, the statement of cash flows, statement of cash flows, the notes, and the disclosures. Those are critical. Me omitting a disclosure is material. right? The omission of a disclosure is material. It has nothing to do with numbers. So it's not about the 5 to 10%. You've omitted a disclosure that you as an auditor consider to be important. It is material, right? Okay, great. So you have this auditor's report, and we'll talk about, of course, about this idea of an unmodified opinion, and as we go along. But think of this as being happy. I'm happy, you know. I'm not changing anything. My opinion is unmodified. That's the technical term. And so your report this report is made up, of course, of a number of areas. Of course, your opinion being the core thing. And this opinion saying that you have, sort of going through, we have, I mean, again, like I say, the audit, we have benchmarks, don't we? We have international financial reporting standards, international accounting standards. So we have said that you have prepared your accounts according to the international accounting standards and financial reporting standards. And we see that there is no material misstatement due to fraud or error. And that's kind of where we're going. And we're telling you what we have looked at in that period. So again, like I say, really the question here is that we should also state, which sort of makes sense. I talked about earlier on. First of all, in your exam, no one's going to ask you to write this out. No, nothing. It's just you knowing as part of our class. No one's going to ask you to draft one. No. It's just so you know the parts of it. And the basis of the opinion, the basis for the opinion, forgive me, is really what standards you've been using. And if you like, there are standards on auditing. Been playing with them. You don't need to know the numbers, but a lot of ISO 760, ISO 750, they just give us guidance as to how to actually carry out these audits. Of course, those ISOs include that 5 to 10% and 1 to 2%. I'm sorry, 0.5 to 1% of revenue that we talked about earlier. So typically, again, you have the basis for the opinion because you were really saying that we've conducted our audit with international standards on auditing, if you like, and that is really the core thing there. That's the main point. So I mean, I'm talking about this slowly, and I will keep highlighting where these parts make sense with a slight overlap. Now, for listed companies only. So what we have here is I think hopefully we'll see some examples as we go later on, and that will mean we'll get through that faster, of course. Now, and even when I trained, we had companies listed on, for example, the alternative markets, the AIMs, the alternative investment markets. I think there was only one. When I say list of companies, not with a parent company, we tended to do audits on subsidiaries in Manchester, where the main companies, the head offices were in London. So the London office would deal with that, and we might, work together on their subsidiaries around the country, or they might bring us in to London once in a while for sort of a bigger audit. So sometimes on these audits, what you have as part of the audit is that typically you might have areas on the statements of financial position. Now, I know, so think of under the assets, typically we're used to hearing property, plant, and equipment, and under current assets, we're used to seeing trade receivables, if you like, and cash and bank and prepayments. But for listed companies, they have so many instruments, if you like. That was the classic, so many financial instruments, so many specialized instruments, specialized events, that sort of thing, that even before the audit begins, because we take a risk-based approach. We're like, okay, listen, because this is a listed company, we're already aware that there's already a lot of risk associated with this particular area. So it's not that we're ignoring the other areas. We're just saying these particular areas are just risky areas. We're just saying that we will spend more time, because, like I said, you could look at a set of financial statements and just look at it and think, well, I saw that property last year. It's the same property that's come back. It's just not risky. I'm not going to bother myself. Spend half 2 hours on that. Assign the time, 2 hours. You've just gone out there and collected all these instruments, or you have some new IT system that you've just implemented. So I just want to say, make right from the get-go as part of my planning that I'm going to spend time on this area, if you like, and address that. So typically for listed companies, because what we're trying to do for our users is to allow them see the work we've done. You know, that's what we're really trying to say. If there are none, well, then we must have a discussion with, if you like, those in charge of governance to be sure that there are no sort of areas in particular that we're not saying there's anything, we're just saying that we spent more time on this area, and they are true and fair. We're just saying that we just thought it was important. We highlighted that we spent a lot of time here working pretty much typically from planning. We already suspected that we'd be spending more time here. And so that's what we refer to as our key audit matters, if you like. So you can see here it says these matters were addressed in the context of our audit of the financial statements as a whole. So typically, from my experience, I remember these were matters, especially where we had to bring in, say, an expert to come in and help us with evaluation. Really areas of judgment that were material. We felt we needed some more additional sort of guidance. Right. Now, if you look at an annual report, right, you will notice that when you open the annual report, you don't open with the financial statements. You will open with the chair's report, and then you will open, and at the back of the report, well, the chair's report, and you would have some kind of OFR, operating financial review, where they've done some of their own numbers. Then what you would get at the back is some sort of, well, actually, you might get a CSR statement coming through as well, right there as well. And you might have some ethical talk about how they're being ethical, and you might have some business about I don't know, carbon emissions and things like that, if you like. So the first thing we want to state clearly, and I want to sort of highlight it here so you can clearly see what I was talking about earlier on, is that what we also say in our audit report is that apart from those statement of financial positions, statement of profit or loss, statement of cash flows, and the disclosures, we are not responsible for anything else you're reading in that document. I mean, I'll come to the bit where we do read it and we look for correlation. But the problem is with these statements, if you notice, is that it's language. You know, the chair could start off saying, the chairperson would say, "Listen, we've had a wonderful year." Now, wonderful, again, opinion. What does wonderful mean? Now, someone could look at profits of 5% increase and think that's wonderful given the climate. Someone could look at it as in, I mean, we don't have benchmarks for the meaning of wonderful, and we cannot stop the chair from writing. After all, I mean, we're just independent. We came in there to look at financial statements. So we're really saying, well, listen, if we feel it's excessive, then we will say you need to tone down on what you're saying, but we still give ourselves sort of saying, listen, you know, you read and how excited you want to be. The financial statements are there, if you like. So the key point here is that management is responsible for other information. The information comprises, like I said, the chairman's statement, and it does not include the financial statements and the auditor's report. Our opinion does not cover the other information, and we don't form any kind of assurance. We just can't. I used to have a colleague who worked with PricewaterhouseCoopers, and he worked in auditing carbon emissions, and that he worked there literally for so many years because that's what he just did. He just went around, you know, auditing that. It's a specialist kind of audit. I mean, it's very similar to all the other ISO sort of environmental audits. So they will include those as part of their reports, as part of their statements, but you would need to refer to that. It isn't a financial audit that we were doing, you know, because technically we cannot really document that in the numbers in the statement of financial position. There's nowhere for it on the A is equal to A minus L is equal to C type scenario. So we just can't. But I'll talk about how we don't ignore it. We still look at it to give ourselves comfort, but we don't audit it. So you can see here, ACS, like what I was saying, so our responsibility is to read it and consider whether it is materially inconsistent with the financial information. And if based on the work we have performed, we conclude there is material, we conclude that we are required to report that fact. We have nothing to report in this regard. So if we feel that it is excessive, we can state that and allow the users to make that judgment, if you like, as to how far off these happy statements are. Right. And then, of course, the rest of the report, remember, this is the report. You see, so I want to highlight here, there was the opinion, which is what we are centered on. And then there's the report, which is the rest of the basis, the key audit matters, other information, the just general responsibilities, who's responsible. Again, trying to reduce the expectation gap and letting users know, because many people just might not know. You'd be surprised that we don't prepare the accounts, the management are, and they're responsible for running the business. And if you like, what our own responsibilities are, so that users are very aware of what we are there to do. Again, nothing crazy, kind of highlighting what we've been talking about. Our job is to assess the risk of material misstatement, to assess the risk of to gain an understanding. How do we do this? It's the risk-based approach, gain an understanding of internal controls. We will assess the accounting policies, if you like, in place. You can see here and the reasonableness of the accounting estimates and the related disclosures made. We will look at going concern. We did this last week, kind of highlighting. But to be fair, these are all no one will ask you to write this. It's not going to happen, so don't worry. But these are standard reports that are just there. The only reason I come to talk about it in this depth is because now I end up teaching on it. When I was working, these were just templates that were just there. You just printed them off. And so you've looked at going concern and ensured. I'll say it again. Sometimes saying it out of context is really important. Remember at the beginning of this page, it said that this was an unmodified report, that we were happy. As long as the client has disclosed that they have some going concern issues, then the accounts are true and fair. Going concern is to do with the future. The current accounts were fine. We're just saying that they're having some going concerns and they're looking as to how to address those. And then you as the investor can make your own decisions. So you can see here, I think it might here conclude on the appropriateness of their use of going concern. And if we conclude that a material uncertainty exists, we are required to draw the attention in the related disclosures in the financial statements, or if such disclosures are inadequate, to modify our opinion. So we will highlight this as I carry on. They will highlight it first, that we are having some going concern issues. We will also highlight it as well, and we're okay. If they refuse to disclose, then we have a problem. And of course, overall, look at the overall structure of the financial statements, and just sort of make sure that the accounts are everything's been included, and the accounts are fairly there's a fair presentation. We were happy with the presentation. Right, and of course, there's this kind of that we have complied with all relevant ethical requirements, regaining independence and relationships. These are all and related safeguards. So these are all the things we talked about very early on, right at the beginning, regarding self-review, that we're not reviewing our own work, that we didn't prepare the accounts, that there's been, we're not related to the director, that sort of thing. Right, and then you have all of that. And that if there was, that we didn't have anyone who owned shares, like we talked about, all the auditors are independent enough to have given a fair opinion and all of that, all of those issues. Right, so that's kind of your first starting point about what the report looks like. This is what the sections look like. Again, an explanation of the sections. Again, I haven't seen, to be honest, if you had this type of thing ever come out, it'll be a small 4 or 5 marker. Like, what are the parts of the engagement? If you like, an engagement contract. So it's really like just you to highlight the fact that it's important that you understand that kind of what we've just been talking about. You almost stating that these things sound same simple marks, but there, if you like, the title, who it is addressed to, your opinion, the basis of your opinion, the key audit matters, other information, responsibilities of management, responsibilities of the auditors, and any other legal and regulatory requirements, and your signature. So that's kind of the template that I think is just good to kind of be aware of, but no one is going to ask you to start drafting one. Cool, great stuff. And so here's the fun bit. here's the bit I think that's you know, relatively interesting, because it means that there is element for debate, and you should always be confident that if you conceptually understand what's going on, that you should always get a good enough pass. And if you get it on the money, then full of marks. And even if you disagree with the examiner somewhat, you'll still pass, and you'll see where I'm going. So again, like I say, I'm really pleased that they have actually kind of simplified things and made the language so much more straightforward. So I'll talk about it first as it is now, and maybe highlight some of the issues of how it used to be. So like I said, if you go in there and you look at your, I'm just going to pretend here, you go in there and these are your assets and these are your liabilities, and that's your equity, and you have your statement of profit and loss, um, expenses, I guess I should use C, and you have your disclosures, and you have your statement of cash flows, if you like, and it's all nicely laid out. If you like, you from your cash flows, I mean, we'll talk about this when we do FR, financial reporting, which will be in September, hopefully. Yes, I say hopefully because we have to take things slowly. Please tell the Americans. So we have the operating, if you like, cash flow from operations. You might, if for those of you who, definitely for those of you who did your, I know AAT level 4, you do cash flow, I'm sure, because I have taught that. And I know university programs definitely will do. So operating, say, cash flow from operations, cash flow from investment, cash flow from financing, and you add this whole business together in effect. And if you have all of this nicely laid out, you have looked at all the assertions about these balances. So for example, they said they had £10 million worth of assets. You did the existence checks, you did the valuation. If you like, you did the rights and obligations, or the rights, and it give or take, it was close to maybe say 9.991, and you're like, oh good, this is not material. And you do the same for you go out there and you do the circularizations, you do the sales cutoff tests for income, you go through all that rigmarole, all the disclosures we're expecting. They have a court case, no problem. They've put the right provisions in, or they don't have the right provisions. They've made there's a contingent, you've put a contingent liability. This business, you've looked at their going concern, you've looked at the next 12 months. Their clients remain the same. Flow will continue, cash flows will continue to happen. So they're a stable business. They have cash flows coming in, and you have been able to do your variance analysis and you carry out your ratios, and you are happy. We give what is referred to as an unmodified opinion. This is a place of happiness where we do our work and we get paid without any questions. Sorry, you're laughing. Sorry, I'm not sure if you were laughing there. But this is the aim, to get paid, and we're all happy. Go home and we just carry on watching television like nothing happened. So that's what we're aiming for. That's what we're aiming for. And everything I just talked about is what we see. You have your title, addressee, you have your opinion. The accounts are true and fair, prepared in accordance with the IFRS's, blah, 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 blah. Key audit sort of basis for opinion. We have used the international audit standards. Again, like I said, unless you're a listed firm, there weren't any particular areas we wanted to look at, or we felt that you know, there's no key audit matters to discuss or to even think about that we, as part of our planning. So again, I want to keep highlighting the key audit matters really features as part of the planning stage. We're going in and we're thinking, oh, you guys have a new system, or you guys have some new funding, you guys have some new financial instruments, whatever, some derivatives and some new shares that are that you're holding, some instruments that are volatile, if you like, the change in value rapidly. I mean, think about it right now, like what's going on in terms of the valuation of financial instruments, or even shares, I probably will stick with shares, for example. Those who probably have gone through over the last 3 months, right, some up and down motions. The question is, financial reporting gives us standards on how we recognize shares that are held either for the long term. Well, to be fair, shares are always recognized, if you like, at in real time. In effect, we don't wait. So we would then be trying to make sure we would be auditing to make sure that the value of that share is what it was on the closing date, if you like, and is kept in real time. So, and that we're happy, and all is well with the world. So I think, let me just see what is here. Yes, let's talk about that first, and then we'll come back to the other bit. So, like I say here, the report can include an unmodified opinion. Remember, this is important, that the unmodified opinion is just part of the audit report. So you have an audit report which had all those things there that we talked about: title, addressee, whatever, responsibilities of management, blah blah blah. But the opinion is just part of that. So we have an unmodified opinion, and which gives a true and fair view. I will come back to these two. So let's discuss again and just see what I talked about with an unmodified opinion. So kind of formalizing what I was talking about. When the auditor concludes that the financial statements are prepared in all material respects in accordance with the applicable financial reporting framework, they issue an unmodified opinion in the auditor's report. And what does this mean? Again, like I said here, you are happy that the accounting estimates are reasonable, the information is relevant, reliable, comparable, the accounting policies applied you're happy with those, the terminology being used is appropriate, and that sort of thing. Yeah, here we are. Some paragraphs within the report. The other information revised, key audit matters containing. Yeah, so I mean, again, just because like I say, just because we say we were spending time looking at some things, you can see that the first thing there was our opinion. So once we say the accounts are true and fair and we're happy, when anyone starts reading anything in the key audit matters, all they're reading is that, well, you spent some extra time here and you're still happy the accounts are true and fair. It's not that anything is bad. We're just saying, and there's nothing bad by this expression, key audit matters, as well. Right. And all these again, like I say, other information just highlights our obligation towards these areas. And I talked about other information from the chair's report. The chairman's statement is probably the most popular one. So here we are. So the other information section, like I say, refers to, again, I gave you a range of things. So examples of the chair's report, OFRs, social and environmental reports, corporate governance statements. And really, we just bringing to the attention that we don't audit this. That's all. But we do spend time looking over it. State that the auditor has not audited the other information, and so we do not express. It's very important to just highlight that, just for your own general sort of understanding. We don't express an opinion on that other information. We just don't. But again, like I say, where there is some very clear divergence on what we think. So, for example, the year we have seen losses, we have seen a fall in the performance measures, and yet the chairman says they've had a wonderful year. Then, if you like, there is something to flag up and to highlight and ask that maybe you are inflating or in fact not telling the truth. So we do have some duty you see, because like I told you, if you remember last week, I said we prepare an audit report, we send it to them, and then they include it, the client includes it as part of their annual reports. So, we have to kind of wait. So we must not knowingly be associated with information that is misleading. That's the key point. So I think what it says here, it sort of gives us some steps, and who knows, you might get something light on this, a later marker. Nothing, can't be a major question. Basically assess to see whether or not to evaluate the consistency. So like I say, it depends. Who knows what is being said? you're just looking the extent. If they're talking about, they say, oh, listen, our profits went up by 5%. If that's what if the chair decides to say that, or well, they like to say things that are very tricky. It's all about statistics, isn't it? Someone could say something like, our profits have improved by 5% over the last 5 years. Now, profits might just have fallen this year by 20%, which is what you're highlighting in your accounts. But what they've done is they've gone back to a very good year, and that, of course, has increased the average and turned what looked like a negative dip into a positive overall. So that it's, so they can tell you, listen, we're not wrong, but then you're like, well, this is misleading. It's misleading, and that's the issue, because accounts must be relevant, if you like, must be relevant. So that's kind of the difficulty, isn't it? So you can see here, it's about how far are you willing to argue this. So discuss the matter with management, ask them to make the correction. If they refuse to make the correction, let those charged with governance know. If the matter remains uncorrected, the auditor must describe the material misstatement in the auditor's report. So you can see here that it doesn't tell us to go and change the opinion. It just says that we should describe this difference in the report, if you like. So we're not changing the opinion per se, because we never audited it, but we are just highlighting this difference in the actual auditor's report under other matters. Okay, great. And we saw that other matters typically came below the other information is included below the basis for the opinion and the key audit matters section. I think this is just important that you sort of know this, but sorry, I don't even think it's important you know it. I just think it's that it's in there, that you should be talking about it. These are all quite theoretical things. I think it's the practicality of things. Okay, great. So yeah, so we'll come back when I talk about disclaimers of opinion. We'll come back and talk about this question of a disclaimer of an opinion here. So yeah, we'll come back and talk about this here. But let me just read it. So when I come back and talk about it, so it says, if the auditor issues what's referred to as a disclaimer of opinion, the other information should not be included, as this may overshadow the disclaimer of opinion. This is quite an important point, a disclaimer of the opinion, but we'll talk about that. And so these are all like, I was going to go to James or Hannah. If you go out and audit, what you'll notice is that you have the option in the audit software to tick all these boxes. So sometimes we don't have to show all of these issues, all of those parts. Sometimes we could just tick a box not to even show key audit matters. We can tick a box not to show other matters. This is because it's an exam, they're showing us everything. So in reality, we rarely show all these other issues if we don't have to. Again, like I said, these are really matters for big listed companies. Under normal circumstances, we're not showing other matters. We're not talking about key audit issues for normal, small, and medium-sized unlisted companies. So again, let's just focus again. I talked a little bit about when we talked about key audit matters. So this is, first of all, like I highlight again, this is to do with listed companies. And what we're dealing with here, again, is that during planning, during planning, we just wanted to spend some more time, or this is an important balance, and we will devote, from a risk-based point of view, we're going to devote a lot of time to these balances or to these areas. Again, it could be a range of things. I think these are what we now see here are some examples, if you like. You can see here it says where key audit matters include areas of higher assessed risk of material misstatement, significant risk, or where significant auditor judgment, if you like, is required, where there's a high estimation uncertainty. So you can see it's really a matter of judgment that's causing us to choose whether or not we include these issues as part of our discussion. And so we can see some examples here. Again, like I say, for me, my experience, it's always been this valuation of financial instruments, fair values, IT systems, just things that we've picked up on the board minutes that we're asking at planning stage, or you told us last year were going to happen. that we just felt we wanted to spend some more time doing our audit work. And that's what we're talking about here. Yeah. So I think what I said, as I said earlier on here, is that that we are happy with the accounts when we see key audit matters. We're not saying that there's a problem with the key audit matters. If we weren't happy with a key audit matter, we wouldn't write it in key audit matters. We wouldn't say we're not happy with this. We're not saying key means problem. I keep emphasizing that, which is what they make a note here. So note that a matter giving rise, if there's a problem or whatever. But yes, so now yes, if there's a problem, yes, by nature, they are key audit matters, fine, but this is not where we discuss it, if you like, right? We have an area for that. We have an area for that. So just think of key audit matters as matters that come up at planning that we want to investigate and spend more time on. That's all, really. We will discuss where we have problems. So again, if there are no key audit matters, that's fine. Just state there are no key audit matters, typically. And this is for listed companies, listed organizations. Right. So that's the first bit. So let's go here. Let's come back here. So I was happy, and I had my unmodified opinion. Key audit matters. We spent time on it. There's no problem, and we were all right. Now, last week we looked the key issue that, and I want to highlight it here. You can scribble, make some notes on that on your page here. Is that at the beginning when I started talking about my opinion, I was stating that I was looking at my financial statements, my statement of profit or loss, my statement of financial position. I was looking at my statement of cash flows. I was looking at the notes, and I was looking at the disclosures. If a client discloses, we give an unmodified opinion. We are happy. We just want you to disclose. So you can see here that we have this next section which talks about an unmodified opinion with additional communication. So what is the first big one? The first big one, of course, is this. It has a little heading of itself called material uncertainty related to going concern. The client is having some issues. We looked at going concern. Like I said, anything you think of could be a going concern issue. We could, if you feel we picked, doesn't really matter where we're going, really. Any of those issues we picked up from loss of clients. It could be basically a pestle SWOT analysis type thing that we've done. And you guys have agreed that this is a going concern matter, something to think about, if you like. So the client will disclose in their notes that we are having some going concern issues and blah, blah, blah. And that's great. So the opinion, the accounts are true and fair because they have disclosed, if you like. What you do in addition to that is to create another paragraph, if you like, referred to as material uncertainty related to going concern within the audit report, if you like. You have another paragraph that you have below there, and you discuss this issue. So in effect, what this paragraph is doing, what you're saying, I almost believe, and I'll see it, is that you are bringing to the attention of the users that there is a going concern matter, by the way, but the accounts are true and fair because they have disclosed it, if you like. That's the first thing. So as long as there is disclosure, if there is no disclosure, the accounts are modified, right? This is important. If they don't disclose that's going concern, then the accounts are modified. So we're not even bothering ourselves with the bringing to the attention. Do you see where I'm going? So the only time you would have this paragraph is if things were unmodified, if you like, because I've given an unmodified opinion and they have disclosed, and I've created another paragraph to bring starkly, clearly to your vision, look and see that these accounts are currently threatened in the future. or this business is currently threatened in the future. That's the first thing. So we might have other matters that are not going concern. I mean, going concern is just, big, so it has its own paragraph. You might have other issues that have been disclosed, but that you still want to bring to the attention of the clients. They have disclosed of them. And typically, the one, again, like I say, the most popular ones, in practice that you feel that you want to bring to the attention. Now, remember, to give you some kind of space about this, think of it like this. Key audit matters you picked up at planning. You're like, okay, listen, these are things we need to look at, whatever. But at the end of the audit, other things crop up, and you have things that are happening after the year end that you're thinking, we should also bring this to the attention, right? So kind of like your non-adjusting events. Things that you just couldn't have known about, things that you would have that are being disclosed, but you just couldn't have known at the beginning of the year. They weren't to do with you auditing or not auditing them. These are events that have happened, if you like, post year end, or that you feel that were happening near the year end that could threaten possibly, or things to just think about. You can see it's all just about sharing that you consider to be material. That's the important thing. And that the client has disclosed. And your most popular one to a certain extent would be a court case, if you like, a court case that is material. So a court case where there's a certain liability, and you still want to bring it to the attention of the users. So that's probably your most popular one. And we'll see some examples of others. I think another good one, again, when I talk about a non-adjusting event, was the fire. Remember, we talked about non-adjusting events being like an example of fire. So for example, imagine an entire warehouse was burned down. We don't adjust the financial statements for it, but it's not quite a going concern matter, but it is something you want to you feel that I would like to bring it further to the attention that you've lost your inventory, or inventory in a number of places. So I think it's important. So you can see all of this is a matter of judgment, because you and I might think, they've disclosed, do I want to bring it to the attention? But again, we would follow some sort of tick box, and we would have examples within the international standards on auditing. That's the good thing about that. Those big standards give you examples of things you can, and they try and include as much as possible. And typically you will find that what you're facing isn't new, so you'll be able to make a good decision. And of course, before these books are really important. Especially before we had Google. Now you can go in and you can see a range of other reports of how other firms insert theirs and whether or not they include, and then you're thinking, okay, we will. Right, and then finally we have other matter, and I'll talk about that when I get to other matter. But you can see here that I have no problem with the accounts. The accounts are fine. I just want further disclosure, and I want to draw attention to that additional disclosure. So let's look at that. So we have here, so this is, and they're just referred to as additional communication. And like I say, at the end of this, I'll explain how it was different to the past. And I think this is really good. This is much neater. So what, like I said here, the first one we'll talk about is material uncertainty related to going concern. Kind of what I've said here. This section just is included where there is a material uncertainty regarding the going concern, in which, please highlight this, in which the directors have adequately disclosed. I've said that before in the financial statements. And what is the auditor trying to do? Draw the attention of the user to the client's disclosure note, sort of bringing their attention to what is going on here. And you can see here, it is typically put in below the basis for the opinion section. So technically, kind of, again, like I said, because even when I looked after any smaller audits, I didn't see many key audit matters coming up. So typically, once I had the opinion, the basis for the opinion, I would have straight away emphasis, material uncertainty related to going concern. So typically, after basis of opinion, you typically had these other reports, these other sort of headings coming in. But again, like I said, this is strongly connected to going concern. and that's it really. Nothing untowards really. That's the test you will see in the exam. Whether or not the client has adequately disclosed that there's a going concern issue. I'm sure in the exam, I've never seen a question test where they start trying to get you to evaluate going concern. There's no time, but there's just you understanding the knowledge of it. The next one I talked about was this emphasis of matter. So an emphasis of matter is referred to a matter that has been appropriately, again, you can see they're very clear there, that has been appropriately presented or disclosed in the financial statements by the directors. The auditor's judgment is that these matters are of such fundamental importance to the user's understanding that they should emphasize the disclosure. So again, like I said here, really we're talking about uncertainty relating to exceptional litigation or regulatory action. So typically it's where you have litigation, you have outstanding events that we don't quite know the results for, and it would be misleading. It wouldn't be complete to ignore these, because all you'll have is it'll happen, and the users or the accounts will say, "No one told us. We didn't know. If we had known, we wouldn't have invested." And you can see here, like what I was saying here, a subsequent event occurs between the date of the financial statements and the date of the auditor's report. So you can see here, this is your year end, and that's your auditor's report. So typically we have events happening here that we could not have planned for. So it has nothing to do with key audit matters. It's just that we have events happening post year end, and that are typically non-adjusting, which is why we're stuck. This is academic early application of a new accounting standard that can happen, and that could change the valuation of certain things. Typically, I imagine the shocks here would be financial instruments. If you think about it, it's going to be hard to push through changes to standards on non-current assets, even inventory. Those are where the big standard shocks could be, revaluations and things like that. But it's typically those volatile balances that are potential. And I'm talking about a standard balance sheet. Who knows? You could be talking agriculture, that sort of thing, and you might have issues there. But this is not as common. This is not as common as this question of litigation and regulation, or potential fine, something along those lines. Or major catastrophes, like I said earlier on, that have significant effects on the entity's financial position. So catastrophes, I've gone for inventory. It could be something else. It could be and you might even be expecting the insurance money, but you just want to bring people to the attention that this is something that you feel affects the importance to the user's understanding. You can see this is very open. But the key point is it just really allows the user to be aware, so they can then decide when it comes to either the valuation of the business going forwards. So in addition, so these are some other things. The additions have been used if they are prepared on a basis other than the going concern, the corresponding figures have been restated, and they have been recalled using an amended auditor's report. Okay. I think typically the first four that I talked about are your typical cases that we see for needing an emphasis of matter. But again, for you, from an examination point of view, what the examiner wants you to be comfortable with the fact is that all these things that we've talked about earlier on have been disclosed in the financial statements. And again, like I say, this usually sits under the basis for opinion section. So typically, if you like, that's typically where you're going. And once you have your basis for opinion, typically we're jumping to responsibilities and for both parties. Right. So here we are. So yes, again, you can see here, like I say, it says when a key audit matter section is presented in the auditor's report, an emphasis of matter paragraph may be presented either directly before or after this section based on the auditor's judgment as to the relative significance of the information. So you can see all we're really trying to do here is that we're trying to, because I don't know about you, but when you're reading reports in general, once you've read the first, you know, the 80-20 rule generally, you want 80% of the key information in the first 20% of the time, if you like, because people don't have time to read a lot of so you want to make sure the most important pieces are right up there. So after opinion, after basis for opinion, you want to stick those in. But the question is key audit matters, judgment, should you put that before or after? But you can see again, it's that openness again of deciding whether you feel this is important enough. Okay, great. So I think that's kind of the issue here. I think, again, like I say here, how in practicality and how it would work if you're writing about it, like I said earlier on, is that key audit matters tend to address issues that we knew prior to going into this, and we're spending time on it. Emphasis of matter issues tend to arise on issues like you saw post-year end, non-adjusting events. So we shouldn't really be duplicating matters in both. No. If you like, because the accounts here are true and fair. So that's the issue. So the key audit matters, we shouldn't be seeing the same issues in both. So you can see here it says where adequate disclosures, an emphasis of matter should not be used to highlight an issue already included in the key audit matters. If you like, the auditor must use judgment to discuss, and I've just kind of given you the standard thought process behind the two. Yeah. Right. Now, other matters. I've always liked to call these, you can write a little note here. I like to call them personal matters. Personal matters. So these, in fact, don't really have to do with the accounts themselves. They just kind of have to do with issues that the auditors are having, maybe with the client, and they just want those highlighted. You know, because they're not to do with the accounts itself. If they were, you'd have put them in emphasis of matter, right? But you know, you're upset, or they're upset with you. There's a problem. There's a problem somewhere, or it might be external. So it might be to do with other laws, local laws, things like that. But it allows me to separate clearly what's going in what. But you still feel they are relevant. So they give us some examples. So and again, they arise because there's been some issue. So it says to communicate that the auditor's report is intended solely for the intended user, should not be distributed to any other party. So typically you have, if you like, we see court cases. These are all extra things that arise. It has nothing to do with the account itself. It's more to do with the legal issue. So for example, someone has relied on our account. A third party has relied on the auditor's report based on what they've read. But the auditors prepare it for the shareholders or the key stakeholders, the shareholders, not a bank, if you like, that needs these, that wants to give a loan, if you like, unless of course the bank did expressly ask for it. So again, like I say, those kind of notes, so that we give ourselves full protection. We give ourselves create limited liability for ourselves to prevent someone coming along and suing us later. You can see here, I said personal matters because it explains why auditor has not resigned and why a pervasive inability to obtain is imposed, but the auditor is unable to withdraw from the engagement for legal restrictions. So you can see it's to do with this fact that these other issues that they're not numerical issues, if you like. They're not to do with the preparing of the accounts, not to do with matters on the actual financial statements, but other issues that we just think it's important that we also draw attention to, if you like. This is where an entity prepares one set of accounts in accordance and a different one, and we have reported on both sets. And this is not unusual. This is not unusual. I did as part of sometimes, I mean, companies are global now, so you have American parent companies with subsidiaries in the UK, and so of course UK GAAP and US GAAP is different. Our standards are different, although we are all trying to move towards international financial reporting standards. But there are many companies in the UK that still use UK GAAP and still use FRISIs or financial reporting standards for the UK. So for small entities, so it is normal to sometimes end up preparing both sets of accounts and having a joint group of auditors work on both when they're preparing both standards. That's possible. So that's what you have that. So I don't really think, I think it's just you being aware of what other matters are. No one's going to fundamentally come and tackle you as to what to start writing out the list of the things under other matters. Right. So let's yeah, so you can see here yeah, so it says here that other matters may be included as a separate section following the report on other legal and regulatory requirements. You know, it's very small area. So let's see. Yeah, so I think they're just asking you to tuck it in. Yeah, tuck it in. I would put it, because I was even thinking about where would I fit it here. I personally would have, yeah, put it in this section 9. It's not meant to feature heavily, so it's not right up there. You can see all the others were right up there under basis for opinion. They were featuring right in here, this debate here. Okay, great stuff. So that's kind of when we're happy, when everything is good, and when everything is well, when we're very happy. So let's carry on. So this is what I was saying here again when I say this question of and I'll take you to a little chart that they have. I mean, I do have some slides, but I think these pages actually work because they are neater now and a bit clearer. So kind of giving you a clue. Again, remember these are recorded, but I'll talk about it first, and I'll take you to their own chart to kind of write on it, to give you the standard exam thinking on how to deal with this. So here we are. Let me just create, again, like I say, I'm just going to create a statement of financial position. So I'm just going to go here, PPE, 10 million vehicles, 5 million, and then 15 million. This is non-current assets. Then I have here current assets, inventory, 2 million, and I'll have here trade receivables, 1 million, prepayments, 1 million. No, well, okay, let's say 0.1 million. And then I'll have your current liabilities, trade payables, 1 million. And yeah, I think that's enough, really. Because to be fair, long-term loans. Sorry, I skipped bank, but just because it's never a problem. Bank is, we have external third-party efficient, best evidence we can ever get for it. I'll just call that 1 million as well. So we never should have problems with with materiality with the bank. The bank must reconcile to the penny. So right. So what's the problem here? So this is how we think about this. We have this question of materiality. We need some judgment as to what would we consider material for us to not be happy with the set of financial statements and to therefore say that they were modified. That's the beginning of this drama. So now there are two reasons why. So, I mean, again, I'll come to it, but if you are either taking notes or you are writing or highlighting, there are two reasons why I might not be happy with the accounts fundamentally. Either the the figure or the balance I'm looking at is, I can see it. I can find all of it, but and I disagree with you. So it is actually materially misstated. So for example, let's go, I think inventory is a good one. I look at inventory and you say it is worth 2 million. And I've come along, I've arrived, I've done the stock take with you, I've observed, and I have looked post year end and I can see some of the stock is not selling as you say it should. And really, I believe that stock should be valued at 1 million. So we disagree. Now, why do I disagree with you? Because there is a difference of 1 million. And I have tested this. So let's just say that revenue or profits for the year were 5 million. So you have a difference of 1 million, 1 million over 5. So I'm being purely academic about this, but that's how we must be, is 20%. And I have said that the benchmark is 5 to 10%. So this is material. So it is materially misstated. So I'm not happy. Now, I think you can take this. So I'll go on with the other reason why I'm not happy, but I'm going to come back to this almost immediately. The other reason why I might not be happy is to do with the fact that, well, I just can't see it. I can't see it. So I don't have sufficient and appropriate evidence. So what does that mean? You could say to me, Oyen, actually, yes, I have stock of 2 million. I've seen £1 million worth of stock. I've seen it. But you say to me, Oyen, there's £1 million worth of stock in Fort William. And I'm thinking, Fort William, crikey, that's a bit far. I can't quite get up there. Is it with a third party? Yes, we're trying to reach a third party. We can't get it. And you just write me a note and say, listen, we want to say that we have inventory worth 1 million in Fort William, but I cannot see it. I can't. So because I cannot see it, and really I'm thinking that you should write it down to 1 million, and you're saying, well, really it's 2 million. And this 1 million out of 5 million is still 20%, and it is material, we have a problem. But we have a problem for two different reasons. The first one was because it was materially misstated due to valuation. You know, you refuse to accept that it needs to come down. And the second reason was because I couldn't obtain enough evidence. Okay, great. Now, to hook both of these up together, to highlight this, I will make the assumption, and for exam purposes, you have to make the assumption as well. Every other balance is fine. This is fine. I'm happy with this. 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 I'm happy with this, and I'm happy with this. Who said audit wasn't fun? I'm happy with all of those bits. It's just this single balance I'm not happy with for either of these reasons. So now, let me come to this lovely table, which is very helpful. Like I said, either my financial statements are materially misstated, like I said, so material, like I said, case one, but not pervasive. It doesn't affect all the other balances. This was unique to just this one balance. For exam purposes, you will see when you do the questions, it tends to take that kind of academic position where it's either one or it tends to affect all of them, or there are problems everywhere. And that's the general theory. So, so if it's affecting just the one balance, it's not enough to affect all the other balances. We say we give what's referred to as a qualified opinion. That's the first one, where it's material misstatement. And I will talk about the statements of what that means. We give this kind of qualified opinion. So a qualified opinion is saying that we're qualifying this one area, but we're happy with the rest. And there is a standard format for saying this, and we'll see it in a second. We're saying this problem, this one, we're not happy with it. It's materially restated. but we are happy with the rest. So in effect, we're really saying the accounts are true and fair, except for. So this expression "except for" was it's an expression popularly used in audit by auditors, of course, very common language. So we're happy with the accounts as a whole, but this particular area, this particular balance is materially misstated, and you have refused to change it. That's the first bit. Or, same thing again, I've just not been able to get enough evidence. So it is still material, but not pervasive. So again, the same thing here. I'm qualifying this. This is materially misstated, but not because of misstatement, but because I just can't get it. It's in Fort William. It's in Fort William. That's the first bit, and that's how we analyze this question of modification. And so our statements would be that the accounts are true and fair, except for this thing. Now, I'm going to take this again and apply this to the question of disclosures. If a disclosure has not been included, a single disclosure, in the same way, one disclosure, if you like, again, in effect, here, we're really talking about misstatement, because you have not, that is materiality. It's material. It's important people know about this disclosure. It has nothing to do with numbers. Not all disclosures are about numbers, right? And if you feel disclosure. So there again, the opinion is qualified, if you like. And sorry, we say the accounts are true and fair, except for this one disclosure you have failed to include, if you like. So I'm qualifying it, if you like. And so we talk about what's referred to as a qualified opinion. So again, like I say in the exam, to be fair, they are fair. They're not going to give you, and you can see here that you can see how in reality it would quite be tricky, because it's not always going to be this straightforward as to having just the one balance. But for us, it will have that sense of simplicity where we're looking at the one versus a number. So now what does that mean in effect? So hopefully you can probably see where I'm going now. Imagine inventory we disagreed on inventory. Imagine that PPE, we disagreed on PPE. Imagine we disagreed on vehicles. Imagine you had not disclosed some things. Imagine that there were no systems in place. I'll just go with material misstatement first. Imagine key point here is imagine that we disagreed and there was material differences on a number of balances. Excuse me, on a number of balances. Well, I can see everything. I can see all the problems. We disagree on these balances. So one, it is material, but two, it is pervasive to the entire financial statements, to the entire financial statement. And so I don't give a qualified opinion. I just tell you straight down, straight as straight up, I guess another expression we could use. Then I'm sorry, dude, your accounts are just not true and fair. You see, because here I was saying the accounts were true and fair, except for. Here I was saying, oh, the accounts are true and fair, except for this one balance you and I disagree on. But here I'm just saying, sorry, the accounts are not true and fair. We just disagree on everything. We just disagree on everything. So hopefully your judgment thermometers are sort of thinking, how would I deal with a sort of halfway house? Could be interesting. But, and therefore, this was here for this one. And therefore, for this one here, imagine I turn up, you say to me, oh, sorry, my inventory, I have some inventory in Fort William. I say, okay, no problem. Can I see the invoices for your trade receivables? You say, actually, oh, sorry, those are locked up somewhere. We haven't had access to it. I'm like, okay, can I see your cars and your property? You say, oh, sorry, you're not going to have access to that as well. So imagine I just don't have enough access to systems, or you say, oh, can I see the ledger? You say, oh, sorry, we didn't keep a ledger. We didn't have any access. So how can I verify anything? I just can't. I don't have the tools. I don't have the network or the tools to give an opinion. You haven't let me. Remember, the reason I gave you the reason here with the inventory in Fort William was, well, I couldn't see it. I just didn't have any sufficient. I didn't have sufficient and appropriate evidence on one material. So I was happy to say, okay, I can see everything else, but this one I can't see. So I can't technically give an opinion, but I'll just say everything else is fine except for this one. But now I just can't give an opinion because it's affecting, there's so many balances that are affected where I can't grasp actual physical, do any testing and get any information that I need myself, if you like. And so we don't give an opinion. And that's what's referred to as a disclaimer of opinion. We just don't. So it's not about it being adverse. No. You see, adverse is that we actually disagree. The accounts are not true and fair. Here I'm telling you, well, I can't find anything. I can't give an opinion. I can't give an opinion. So what I suspect happens is that under exam conditions, I mean, I'm going to come back now and go through the pages as usual in the text, but if you kind of get it, then you start, again, like all things, it's about practice, right? As you practice in questions, you start seeing issues. I said earlier on, your first task is to calculate materiality. Whatever balance it is they give you, do you take that balance as a percentage of profit before tax? If it's greater than 5%, I'll say 5% actually, then it is material. Then you then scout around to see if there are any balances relating to this set of accounts. Are there any other issues? No. If it's an isolated issue, then you were able to test it. That's great. Or if you weren't able to look for it, then you're looking at this question of sufficient and appropriate evidence. And with practice, we start kind of getting used to the questions and seeing the different types of examples that arise. Yes, right, good. I think we should take a break. I think that's good. So we'll take a break and then we'll come back to the theory, to the expansion of these points in the written pages coming up. So yeah, let's take a 15-minute breather and let's come back at 11. Cool. Thanks. See you then. Okay, welcome back. Let us carry on. So we are here on modified opinions. So these are just the notes, really, to kind of support the theory and the concepts we addressed just before the break. So let's just walk through them and just kind of tick the box, really. So yes, you may, says the auditor here, may need to modify the opinion, and based on that evidence that the accounts are not, the financial statements are not as a whole free from material misstatement, and typically the reason why we have these differences is because there's some divergence, right, from the applicable financial reporting framework. The example of inventory, of course, was IAS 2, where inventory had not been recognized at the lower of cost than net realizable value. So, I mean, this is why the stating clearly that the accounts have been prepared in accordance with some standard is necessary. Otherwise, we can't find some variance to determine materiality. Or, again, the question here is, like I said, the two key reasons. This is the first one. And the second one, of course, is we've just not been able to get our hands on enough evidence to make a decision as to whether or not the accounts are true and fair. So we have here this question of material but not pervasive. So what I talked about earlier on, just kind of picking up again, if the misstatement or lack of sufficient evidence, right, appropriate evidence, is material but not pervasive, we issue what's referred to as a qualified opinion. This means that the matter is material to the area, just that area of the financial statements, but does not affect the remainder of the financial statements. So two reasons there, and we give this except for this matter. So although still significant, we say you can rely on the rest of the set of financial statements. You can rely on the rest of the financial statements. I think hopefully we'll come to an example of, when I say an example, we'll see the actual statement, so to speak. So if it is pervasive, what we're saying, it is not confined to specific elements. We believe that it represents a substantial proportion of the financial statements in relation to disclosures, or in relation to disclosures are fundamental to users' understanding of the financial statements. So we're basically saying that we consider the accounts to be unreliable as a whole, and that's what we're sort of arguing. So this question of not being able to rely at all on the accounts, again, can sit in two camps. We can clearly see the information and we clearly disagree. So we say here that the accounts do not give a true and fair view. So like what I was saying earlier on, this idea of looking through and having problems right through the accounts, that's kind of the standard starting way to understand this question of it affecting the whole set of accounts. But as well, if the accounts are prepared on the wrong basis, so for example, in addition to this, if the accounts have been prepared on a going concern, which kind of lends itself still to this question of what I was talking about, but this is a more kind of, I guess, classy way of saying it. If you should have prepared your accounts on a breakup basis as opposed to a going concern basis, then you have valuation issues right through all the balances. So in effect, the entire set of accounts are not true and fair. Every balance here is materially misstated because they should be recognized at a selling value as opposed to a going concern value. Consolidation. So this is an external, completely different point again. So I believe Natalie, I know you just did Natalie and Dudley. Did you do even some consolidation at AAT? Am I missing something?
think there was something, Ian.
Just a little, yeah, I'm trying to remember. Yeah, just, so, but you will see it at F, thank you. You will see it at F7, but there is this question of consolidation that we can have. And if for whatever reason, because when we talk about consolidation from a financial reporting point of view, you should, if you control consolidation, if you control a company, you should consolidate. That's it fundamentally. Now, you may say, I won't consolidate because whatever, they're making a loss and blah, 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 blah. It doesn't matter. We don't care. Once you control via share capital, via the fact that it's not just about 50%, as we come to see about this when we come to F7, the fact that you might control 40%, but everybody else controls, like everybody else has got 1%, 2%. And so you're really in control in the boardroom. So you should consolidate. We would consider that to be an adverse opinion because, as you can imagine, this isn't quite affecting the one balance. This isn't quite like a problem with just inventory. We're affecting the very nature of the accounts. So you can see that it's not quite black and white, knowing the difference. Well, it is, but think of it this way. If we're not just talking about the one balance that's being affected, like what I was saying with inventory, where there was some materiality, where it was simply qualified opinion, the accounts are true and fair except for, if it's not that, and it's nothing to do with we can't find enough evidence, we're not in that category, then it will be an adverse opinion, because the full set of accounts here are, as you can imagine, me not adding a subsidiary is not giving you the full picture of this business, if you like. And that's why that's important. And of course, here you can see here again a material misstatement of a balance, which represents a substantial proportion of the assets, which will change a profit to a loss. So in effect, again, now you can see where judgment matters. Say, for example, and this is why it's so important to just take this thing slowly, but again, it's all a matter of experience and time, and you'll get it. Say, for example, like what I was talking about earlier on with inventory. Say, for example, we had the £1 million difference, and that was material, that was isolated. And say, for example, it was just over 5% or 6%. It was material, where it qualified except for, but everything was still in profit. I'm still happy with the accounts as a whole. There's no problem, that's okay. But when this balance is so material, because this balance that we're talking about is maybe significant in these, if you like, in the financial statements, that it overshadows or overlooks. Maybe this is a service, maybe this is either a service company where it's revenue that's been affected in terms of revenue recognition, or inventory. They hold some really expensive inventory, and this is so material that the amount itself turns whatever profit you have into a loss. So you can see here, I think I mentioned earlier on, I'll say it again, you might remember, that a material misstatement, as part of these figures that we talk about, the 5 to 10%, anything that turns a profit into a loss is material. Anything that turns up, any situation where we have, because you see, that's the whole point. I will put I want to put adjustments through to prevent a loss being seen. So if I can put any journal to ensure that a loss goes into a profit, I will, for whatever reason. So where you now have a substantial whatever profit being turned into a loss, then it becomes an adverse opinion. And so hopefully, again, like I say, you will not think of it like this. The examiner, if you had gone for its material, you've calculated it. Imagine it was out of that particular area, was out of 5 marks. You'd highlighted the fact that this is material, 1 mark. You had calculated it, maybe another mark. You had highlighted the fact that this is now material and therefore a modified opinion, another mark. So you have 3 out of 5. Now, if you had gone and said, well, this is unique to this area, qualified except for, another mark, maybe the examiner felt that you could have picked up on the fact that this was big and adverse and should be an adverse opinion as opposed to a qualified opinion. You've already crossed the line. You have passed. It's just that you both differed on just this little point. And it's not common, you will see these differences, but I wouldn't panic if you wrote qualified the first time and then on reading it, it said, well, actually it's adverse because it's so big and it's turned the profits into a loss. Maybe because in your rush, you didn't pick up on that fact, because that's something that should ring bells. Bang. Oh my goodness. Yes, this could turn a profit into a loss. See where I'm going. So because this is trying to turn into academics what is a very practical, what are very practical issues that we deal with in trying to make these judgments. So don't see it in pure black and white, sort of see the bigger picture. Right, great stuff. So that's kind of what's happening with the adverse opinion. Cool. Then with the disclaimer of opinion is what I was saying here. You just cannot give an opinion. I talked earlier on about you just didn't have enough information. So you could give a qualified opinion because it was materially misstated, unique area, you didn't have enough information, or adverse opinion, pretty much to do still with material, you just don't have enough, you disagree on a number of issues right throughout, and you have these sort of issues here, material misstatements. So we can see, again, a disclaimer of opinion you can see here is issued when the auditor has not obtained sufficient appropriate evidence and the effects of any possible misstatements could be pervasive. So you just don't want to express an opinion. So look at some of the examples. The client has not kept good records. They refuse to give you written representation. They provide failure by the client to provide evidence over a single balance, which represents a substantial proportion, again, or over multiple balances. So you can see that spectrum of, I was quite happy with the fact that you couldn't get to your inventory in Fort William, but you were cooperative. So I'm saying the rest of the accounts can be relied on. Sorry, I'm wearing headphones. Can you hear it? Can you can you still hear that shouting? Sorry. Just for the record, when I do homeschooling, none of that happens. I'm just joking, but there you go. They're quiet. But there you go. So the difference is really about the spectrum. The difference is about the spectrum. If this balance is taking over a lot of things, then we cannot, if you like. So let's now look at the what happens next. Therefore, so when if we're giving a disclaimer of opinion, the statement that sufficient appropriate evidence to provide has been obtained, because we haven't. I think this is just for you to know. I don't think anyone's going to test you on this particularly. Is that in the statement that the financial statements has been audited is changed to we were engaged to audit the financial statements. I think this is just sort of almost academic, but the key point is that you're aware as to when we give a disclaimer of opinion. So again, I think what you want to do with disclaimer of opinion is you want to highlight it early on. I think this is what they're trying to kind of raise up. So the key point here is the key audit matter section is not included in the report, as to do so would suggest that the financial accounts were more credible and would be inconsistent with the disclaimer. The disclaimer of opinion really comes right up there, because you just haven't been able to give if you like to give an opinion. So so the basis for the opinion refers to the professional in order to form it. When the auditor modifies the opinion, this section also explains the reason why the accounts are, why the opinion is modified, right? So I'm looking for something here. Right, here we are. The basis, so because you have to tell people why you have chosen to give your opinion, why you've chosen to give a modified opinion. So the title of the section must reflect the type of opinion being issued. So for example, therefore the auditor must amend this heading. So where you see basis, where we've been talking about basis for opinion, we only use this when we are happy. So you have opinion, the accounts, and we'll see those statements, the accounts are not prepared, blah, blah, blah. But when you're not happy, you change it. So it goes from basis for, you can see here, to basis for qualified opinion, blah, 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 blah. This is after your opinion. Basis for adverse opinion. or basis for disclaimer of opinion, if you like. And that's kind of the point, the key point with those areas, right? Remember, you have your title, opinion, whatever opinion it is you're giving, and the basis for this opinion. So yes, and that's the format. That's the format. So again, where a qualified or adverse opinion is being issued, the audit evidence is sufficient to provide a basis for the auditor's qualified opinion, a quantification. So I think you just want to really explain really what's going on here. So this is the actual, this is what you're actually saying in your opinion. So you're actually saying that we believe the accounts are true and fair. I was hoping I might see something, but it doesn't matter. I'll sort of explain it here. In your opinion itself, your statement is very clear. If it is material but not pervasive, so it's just qualified, you're saying, we believe the accounts are true and fair. We have audited the accounts. You say everything is normal. We believe, and that's what all they're testing. This understanding of that. Don't we? I mean, you think about it. There's just no space for them to be asking you to write a full report. It's not possible. It's just, can you pick out what the issues are, and then can you decide whether it's, and what would you say? You say that we believe the accounts are true and fair, except for the balance of inventory at this, if you like, because they are materially misstated. Fine, and then you now discuss that under basis for qualified opinion, which is literally the next line, basis for qualified opinion, which would have been basis for opinion if you were happy. And exactly the same way here, adverse opinion, you're saying the financial statements do not give a true and fair view, and they have not been prepared in accordance with the international financial reporting standards, and blah, blah, blah. And that's enough, really. And then you have your basis for the adverse opinions. I think it's just knowing this and saying it. That's where you're getting the marks, as opposed to writing a report. Here's because it's materially misstated. Here is because we don't have enough information. We're saying that this is true and fair, except for we can't get to inventory in Fort William. It's $1 million. It's material. We can't see it, and there we are. As opposed to disclaimer of opinion, we just can't express an opinion. We just can't express an opinion. Okay, great. And so that's kind of the point. Yes. Yeah, I think this is a little bit here. Nothing really interesting here. If after accepting limitation of scope. So typically, yes, this is an expression I used to see a lot. I don't see it so much here. This is really to do with this question of due to, again, like I say, it's not, I've noticed they've taken a lot out of this here. This is really to do with this inability to obtain sufficient and appropriate evidence. You have scenarios, I mean, again, academic, where directors are not giving you the information you need. So it's really leading you, if you start to see earlier on in the audit that you're not going to be able to get the information that you can need here, this is where this is really heading. I mean, in my experience and most experiences, this is rare. I think most clients want to cooperate to get this audit done with and be done. But of course, if you have these problems where management are not wanting to give you this, what you're really at writing is that, listen, you should be thinking about how you withdraw, because that's not what the initial engagement stated. They told you they'd give you access to all information. So that's what you're writing, in effect, that, listen, that was the initial agreement. We cannot give an opinion. Again, it comes into the disclaimer of opinion. We cannot give an opinion. And that's kind of the you can see here a disclaimer of opinion should be issued, and you should let everyone know why it is you are you cannot give an opinion. This is important. We didn't say the accounts are not true and fair. We just said we cannot give an opinion. So you can see there is a difference there actually between these two that I think is important to pick up on. Okay, great stuff. So just a little section here on we've kind of talked about it before, but I just want to highlight it again. I think it's good, so it helps you to pick up on this. And then we will do an example. There's an example I want to show you, but sort of highlighting some of the issues. So this question of going concern, I've talked about it before, and let's kind of see, just to kind of see what they're really telling us here, which is kind of helpful. So if a company, oops, sorry, what was that? Come here, close this. Here we are. So if, of course, let's look at the scenarios that we have. If we have a scenario where there is no, if we have a scenario here where there is no material uncertainty, everything is fine. Like I said earlier on, companies running well, no going concern matters. You've done your going concern review, kept their clients. And then we give, of course, like I said, we wouldn't even see anything. Remember, it'd just be a nice, lovely, unmodified opinion as part of our report, and we walk away. So it's unmodified, no problem. Financial statements give a true and fair view, no impact, absolutely none, fine. Now, I mean, I'm just, this is really a summary of everything we highlighted. That's the first thing. The second thing here is that if we have material uncertainty, so we felt that there were going concern issues. It could be to do with liquidity. It could be to do with the ratios. You get told material uncertainty exists and is adequately disclosed. Like I said, they've disclosed it, no problem. Unmodified, financial statements give a true and fair view. What do? I create another section called material uncertainty relating to going concern, and I talk about it there simply to draw attention to the users that, by the way, but the accounts are true and fair. Material uncertainty exists which is not adequately disclosed or is omitted. Now, you have not disclosed. There is an omission of a disclosure. So it is modified. You can see my dilemma here. So it is modified, so it is qualified or adverse. So now what does that mean? I need to look at the picture and sort of think that to what extent do I think this pervades the accounts? So therefore, like I said, the question really has to be is, what is the cause of this going? What is my problem with the going concern? What is my going concern issue in particular? Is it unique to one particular balance? Or is it, do I believe it affects the entire, that it affects the entire, it's that severe that it would affect really the entire organization? I think, if I remember, even from an academic point of view, that the adverse sort of view is typically taken. I think it'll be very bold for an auditor to see material uncertainty existing due to going concern, and they haven't disclosed it, and just say qualified, the accounts are true and fair, except for the refusal to put this disclosure, because going concern is so central. So you can see here, even in an exam question, they kind of give almost keeping it open, because they're wanting you to sort of explain. It says, hopefully this will explain the going concern issues management have failed to disclose adequately. Because again, like I say, pestle is an open, such a big open point. It might just be a political issue, or it might be a change in the law that is still under debate. Okay, so maybe qualified except for, but for security purposes, you can see that if you went for adverse, which is what I would go for, and you would still be safe because you've got modified, you've highlighted the issue. You could even discuss the complexity of, or the spectrum of the difficulty. That how severe is it? Does it affect, or does it pervade all the figures? And you can look at it if you like. So hopefully seeing questions will help us practice this, of course, see where it is. And we probably might have a few differences on it. Maybe like, well, that sort of thing. So here we are. Company is not, if you like, a going concern. I think I highlighted this earlier on in this question of adverse, under adverse. Company is not a going concern and has prepared the financial statements on a breakup basis, which is they have done it appropriately and have made adequate disclosures. No problem. true accounts are true and fair. So what we have here is additional communication, and if you remember, they put this sort of again, this is all a matter of judgment. They've put it, I don't think you get penalized for it, because what we tended to do was, if the under emphasis of matter paragraph from an academic point of view, we tend to put things that when you have prepared accounts on any other basis apart from the going concern, we put it in emphasis of matter paragraph. So this is different. I mean, full of marks if you can remember the clear difference between a company that has been prepared as a going concern, and we're just worried about its going concern, which is why we write that. But here we have a business that the issue isn't so much about going concern, it's just not a going concern. They've prepared it on a breakup basis, on a different basis. And so that is highlighted under, if you like, because they're not going anymore. So we highlight it under emphasis of matter paragraph, right? So we don't put it under going concern. It's not going anymore. It's done. So that's the difference between the two. It's just like which is why I just thought I'd just go through this so you can see the slight differences. Here we are, and then here we are. So company is not a going concern. Now we have a problem. Company is not a going concern, but has prepared its accounts using the going concern. So you are not a going concern, and you have prepared your accounts using the going concern. So we have a problem. You should have used the breakup method. So this is not about one balance. This is every balance. Breakup method would affect every balance. So it's adverse. It's an adverse opinion straight away. So the accounts are just not true and fair. The accounts are not true and fair. So it's not even a matter of disclosure. Yeah, the accounts are not true and fair. Hopefully you're seeing this. There's no point saying this isn't about disclosing. You just shouldn't have, yeah. So this one is this one I remember. It says the period assessed by management is less than 12 months, and management is unwilling to extend the assessment. So you can't properly do a going concern review. You really can't be sure that these people are a going concern. You can't fully do an analysis. So definitely, so in effect, to a certain extent, that you don't, if you like, you don't have sufficient and appropriate evidence. They've not given you. It's their responsibility to do it. So really, that's the problem. You cannot qualify them as a going concern. So we're not at the point where we can start putting those statements in, those paragraphs in. It is modified. I think here's the point. Once we start modifying things, we don't have those statements that we saw earlier up there about emphasis of matter, going concern, is when everything is fine and you have disclosed. Here we have issues with your very underlying recognition as a going concern. So this is a case where we probably safer, you'll see in exam questions, to go for disclaimer of opinion, because you don't have enough evidence affecting right through the entire, all the numbers. Yes. It's not about disclosure here. You just don't have enough information. You can't give an opinion. Can't give an opinion. All right. Cool. Great. So there's a number of illustrations here. I think that you can please, that you can read through when you're doing your work. But what I want to do is that, I mean, I just say read through, but I think jumping into questions is the ultimate way of looking at this. But yeah, I mean, again, I don't think. I think it's just reading through and seeing some of the type of text that is used. But I've looked at it. I wouldn't say there's anything there that is that you cannot pick up on doing the questions. What I want to go to next is to look at this area here. Like I said earlier on, I mean, we're trying to pass an exam and we have to be academic about it. And once we're academic about it, we're all right. Your first step always, 100%, is to remember your benchmarks. 5 to 10% of profit before tax. And if you remember this and you have the state solid in your mind, then you can go to the 0.5 to 1% of revenue. This is the core. Then you can go here. These two, you're there, you're done. Recognize the fact that it is material. Recognize whether or not it is due to misstatement or insufficient evidence. And this is where you must state all this. Then recognize, is it enough to affect, is it affecting the entire area, or is it just the one balance? And then go. Then, you could, why not? It's just professional paper, it's a written paper. Highlight the fact that, well, depending on X, Y, and Z, we might want to go for the actually adverse or disclaimer of opinion. But I'm going to go with this. Or I'm risk averse, and I'm just going to go with even the adverse or disclaimer of opinion. So you can see that you're still giving the benefit of the doubt by saying qualified, because you're saying everything else is true and fair except for. Is that actually the case? Is that actually the case? But again, extrapolating from my initial simple analysis to the sort of issues where we go for adverse, right? Fail to consolidate a subsidiary. This balance is significant enough to turn a profit into a loss. That awareness is critical to determining, to shifting into the space of the adverse. Okay, so let's look at what they're telling us. And you will get a question on it. It will come. It always comes. I think it's usually the last one, maybe the second to the last one. So that chunk of ethics, good question on it. Audit risks, audit procedures, and reporting. And maybe some other little bits on subsequent events and things like that. So if you want to make sure you're comfortable with it and you're happy to write about it, and don't worry so much. When I say don't worry so much, what I mean is that don't worry so much as to whether or not should I go qualified or adverse. You're safe if you're at that point. The exam will regularly feature a requirement asking for the implications if issues identified are not resolved. Exactly. Yes. So so it's really the case of, if this is not resolved, so it's a question of, you found something, you ask your client to resolve it. If they refuse to resolve it, then you tell them what the consequences are, is the point. Yes. Okay, great. So like I said, first of all, assess materiality. Yes, important point. If the issue is not material, then it won't affect the auditor's report. I suspect most of them usually will be, because they want you to have a go and say something. Calculate the percentage of assets and profit issues and state whether this is material. Again, it might be a disclosure. I won't forget that. It might be, so it's trying to understand what the problem is. Material misstatement, non-compliance with an accounting standard, insufficient inability to obtain sufficient appropriate evidence, material uncertainty. So this is really about disclosure. This is an event that we don't know about. Or like what we were saying earlier on, it might be to do with the statement, CSR, or after reading the chairman's statement, something along those lines. But like I say, we make a note of this one, particularly in other matters. We make our displeasure highlighted there. Yeah, and I think that's kind of the key point. And then kind of discuss it, if you like, in effect, as much as by just reading what it is. Stating whether it is material but not pervasive, or material and pervasive. Is it isolated or relatively small? Is it as a whole unreliable? And you can see they give you this, again, everything we've just been talking about there. And sort of, if you can, hopefully now that we have time, you can go ahead and just highlight the fact that you will give your opinion, and then you will do your basis for whatever, your basis for your qualified opinion, your basis for your disclaimer of opinion, your basis for an adverse opinion, that sort of thing. Or depending on whether or not it's the other way, where you're happy with the accounts, but you want to highlight the going concern matters or the emphasis of matter paragraphs because they have disclosed and you're happy with the accounts. Right. Okay, great. Just a little bit here, just highlight this point here. This talks about communication with those charged with governance. So typically what would happen is that the big point here really is that at the end of your audit, The key point here really is this discussion about what's referred to as a management letter. So at the beginning of the audit, what will happen is that the audit senior will open up a file and just call it the management letter file. And throughout this period, he will be or she will be documenting areas that they wish to discuss with management or they wish to be corrected, if you like, and sort of anything they disagree with, that they would like with, or deficiencies in the controls that they believe should be worked on at the end of the audit by management. And that's really their communication and things that can be improved. So it's almost like, an advisory letter as to, and also a call to action on issues within the accounts. So really, you can see here, it says that, this engagement letter is at the beginning and the management letter is pretty much at the end. So the two main forms of formal communication, if you like, are this engagement letter, like I said, usually sent at the end of the audit after everything's been done. So really, what are we trying to do to kind of keep everyone, again, issues that we've picked up on, controls that we've picked up on, so that when we come back the second time, it even goes as far as highlighting business risks that may result in material misstatement, approach to internal control, views about matters which may become key audit matters. So really, it's us kind of also kind of, again, you can see here significant difficulties encountered during the audit, just really issues that we want to bring to the attention of management and those in governance, so that next time that we come, things are smoother, really. I think those are the main issues, really. Matters. This would all have been in our engagement letter, but I always like to think of it as, really, you can see this is a summary of identified misstatements, whether corrected or not by the entity, and a request that they are adjusted. Again, I speak only, again, like I say, from experience. They never have all of these. We never talked about all of these things. It was really about the practical things that throughout the year, these are issues that we have encountered. But typically, you'd have a section of all the journals that you would ask to be put through. Because you see, here's the thing, from a financial reporting point of view, there might be journals that are not material, but we'd still like you to put them through because we believe that they should line up with financial reporting. You might say the management might choose not to do so, but at least we have listed them and we've communicated to those charged with governance. And just highlighting the potential effects on the financial statements of any material risks, pending anything that we see that we think that could help you in the future. And again, like I say, if there were any delays, if we ask management for something, it really is our chance to communicate with those with governance, any other matters, if you like, it's kind of highlighting that these were the issues that we faced and we felt that you could have done this better, and this is how we want to do things. Yeah, again, like I say, delays caused by management. Right, great stuff. So what I want to do is I just want to look at TYU3. That's the first one, just to kind of pick up on what I was saying with regards to how we look at this, and just to sort of see how, hopefully you'll see how the questions kind of evolve. Let me just find my calculator. Right, so yes, if you look at TYU3, let's look at these issues. You can get a mixture of scenarios, something that looks like this, where you have a number of issues and how you would deal with it. So you can see that these are different companies. So let's look at the first one. So it says that these people, Aragon, operate a perpetual inventory system. There's no year-end count. You have reviewed the level of adjustments each month after each perpetual count, and concluded that due to the significance of the adjustments, the inventory system is not reliable. Okay, you have requested, therefore, a full year-end count, and management is refusing, saying it will be too disruptive. The inventory balance is 4 million. and the sales revenue is 15 million, and the profit for the year is 15 million. So you aren't quite happy with the valuation of inventory, and so for you, the question is that you can see this here. So it's more the, so again, like I said, in an exam question, you have to assume that because they've only, in a question like this, which you can get with a number of companies, they're almost getting you to focus on that particular balance. You don't know what else is happening in the company. You almost have to assume that everything else is fine. It's just this particular balance where there are issues. So like I said, your tasks are twofold. What you want to do is you want to then ask the question, well, this balance of 4 million, how material is it, if you like? So you would then say, well, I will compare 4 million as a percentage of profit for the year, and 4 divided by 15 takes us to 26%. And that is material straight away. I think it's good. Why not to also do 4 as a percentage of 50? Why not? Because you are in exam mode, so you have the time. And that is 8%. Sorry. Yes, that's 8%. Yeah. So that's 8%. So this is a material figure from the point of view of profit before tax, and also from the point of view of revenue. State for the examiner that you know it's 5 to 10%. State to the examiner you know it's 0.5 to 1%. So the point here is that this is material. So because it's material, you can see what's going on. You want to you will say, listen, please do this. Otherwise, so it's almost advisory. I think, let me see the question. If the question does say, for each, describe the implications, right? So you're saying to the client that, listen, if you don't change this, this would lead to the qualification of our opinion. So I will give a qualified opinion stating the accounts are true and fair, except for this inventory balance. And then you will now state the case for the basis for your qualified opinion. So let's just look at the answers to that first and just see how they frame it. I think that's always a good thing. So you can sort of see here. So you can see here it says that inventory is material, 8% of sales revenue, and 27% of profit. State that very clearly. First, it says there is a lack of evidence over inventory. You cannot form an opinion. Okay, state that. Again, like I say, it's because I'm talking. Sometimes I don't even clearly state this. The audit opinion will be modified very clearly in mark, so you can see where I'm going. A qualified opinion using the except for wording will be used. It is as a matter is material but not pervasive. I don't have more information to know. Again, like I say, if you can, state the fact that the basis for the opinion will be amended to basis for qualified opinion, and this will now explain sort of the core reasons as to what is going on, right? That's the first thing. So that's how you'd have done the first one, if you like, and those are the kind of ways this comes out, if you like. That's the way we see this. Okay, let's look at the next one. So it says that Boleyn has not made an allowance for irrecoverable debt of 50,000 in respect of a customer, and profit for the year is the customer is declared bankrupt, and profit for the year is 50,000. So we would want them. We have enough evidence that they should make an allowance. So this says here, this is 10%. This is nice to see straight away, and this is therefore material. This is material. So if it's material, again, we literally go through that speak and get to the point of highlighting literally the same template as what we just saw earlier on, but just stating the clear reason for our decision to do so. It is material. Again, like I said, it does sound like I'm repeating myself, but literally that is all we're doing. You're literally stating it in that order. You've chosen not to write off this irrecoverable debt. The audit opinion will be modified, a qualified opinion, amend that to that, and explain the reasoning for your answers. Okay, that's that. Okay. Explain your reasoning for that. Yeah, and that was that one. Okay, great. Interesting, this one. Say More is being sued by a competitor for the theft of intellectual property. The amount of the claim is material, and the case could go either way. The claim is not mentioned anywhere in the financial statements. So I talked about disclosures, right? You have failed to disclose a particular a matter. Again, I mean, these are isolated events to a certain extent. So we have, again, qualification on the basis of, if you like, misstatement, because you have really refused to disclose. When I say misstatement, what I mean is you've refused to disclose an event taking place. And disclosures are just as important. They're material, so, and that's the important thing. Because it's a contingent liability, we don't quite know whether or not, if it was probable, then we should see a provision. But because we don't know which way it'll go, well, we know in effect, therefore, that it should be. Okay, great. So it says here, the claim is material and represents, as it goes, a contingent liability should be disclosed. Opinion should be modified, except for material not pervasive. Yeah, I'm sure you would agree. Basis for qualified. So you can see what I'm saying here is, once you get into the structure of always just going with this basis, the basis will explain. You're on the money. You're fine, and quantify the effects of the, if you like, of that. Okay, great. And that was that one. Let's look at our friend here. Yes. So Howard is a cash retailer. It says here, there is no system to confirm the accuracy of cash sales. Now, this was an interesting one. Again, like I say, so that, and let me break it down again clearly so you see where I'm going. I know when I started explaining this, I talked about this business of isolation. But hopefully, as I now went into the notes, I was able to extend that a little. First of all, it's a cash retailer. So it's all in cash. And there is no system. There's no way for me to assess the accuracy of cash. It's just nothing. There's nothing. You don't have a ledger. You don't have a system of recording your cash. So I'm just not going to be able to gain any evidence of this. I know it feels like revenue, but there's quite a number of issues here. There's sales, there's bank. He says cash. Yes, bank it didn't go into the bank. It's cash. So you were the one putting the money into the bank. How do I know that what you put all the money that came into the bank? Which is why the bank issue here, be careful, it doesn't work. I can't confirm bank. I can't confirm revenue. And it's a major balance, revenue. So I already was in my head. I was already thinking, well, there's no system in place. I was already looking at, this is really, it's going to be. Sorry, I thought someone's trying to break in there. It really is going to be, for me, the fact that I can't give an opinion really on this is my safe space for this, which is why, I'll go to the answers in a second to sort of see where they're going. Because really, this is the one reason why auditors are wary of taking on laundrettes, restaurants in the time of cash. Now, I know a lot of card works, laundrettes, just because of the fear of money laundering. Because on the one hand, someone might say, I guess because of the way this looks, maybe everything else is all right with the business. Maybe they have ways of recording everything else. But personally, when I saw this, my instinct was, I'm sorry, we have no way of looking at anything, so we cannot give an opinion. So let's see, and just stating your reasoning, I think is the argument, because again, like I say, is thinking broadly about this. So there is no system to confirm cash sales. Therefore, the auditor cannot form a conclusion. He's not able to, or she's, or whoever knows sufficient appropriate evidence. It is material and pervasive. It will be modified. A disclaimer of opinion will be issued, as you do not wish to give any opinion. And I think that's where it's the severity of the balance. Like I said to you earlier on, my friend who had £1 million worth of inventory in Fort William, I was willing to say, okay, listen, qualified, as in everything else is fine except for. This is cash, fraud, money laundering. I'm sorry, can't help you there. So I think I must have said, maybe I didn't say. I remember we had we weren't doing an audit. We were just preparing the accounts of this. This was in Manchester, and I just even remember thinking then at the time that, I started. I said the partner here is taking a big risk, because we were. I remember I can see the bar, but it was this sort of yeah, okay. For lack of a better word, it was a gentleman's bar, for being professional. And in my mind, I remember thinking that, but this doesn't make any sense, that nobody here pays with a card. All the money we were only preparing the accounts. All the money that it's a registered business. They are legal, and they need for their accounts. But I was thinking, this just doesn't make any sense, because all the money that is coming in here is defined based on what they put through the till, if you like, and they have all kinds of trades happening at the same time, if you like. So us signing that we have prepared the accounts, or because that's what we're saying ultimately, and that the client has given us all the records, is still a risk. And I remember getting the parallel gun argument. Well, if we don't do them, someone else is going to do them, so we might as well do them and get paid. So there you go. So the key point here is that hopefully you can see that if you don't have a system in place for recording a significant balance that has to do with revenue and cash, then we have issues. So you really want to be giving you don't have enough evidence, so you're thinking, okay, it's either qualified or disclaimer, right? So you're thinking, how serious is it? So and then you literally carry on with your point, the basis for a disclaimer of opinion, explaining the reason for your disclaimer, and we are told it is material, if you like, and this. Yeah, I think that's the statement within the auditor's report, that sufficient appropriate evidence will be removed, as in, so highlighting that you were not able to get sufficient and appropriate evidence, if you like, and that the will be changed, was engaged with the audit of the financial statements. Hopefully, as we do questions, you pick up on that. But I wanted you to remember the theme, the core text that you need to understand here. Right, two more. I think 2 more points there to pick up on. Okay, so here it says that Cleves had neglected to include a statement of financial profit or loss in their financial statements. And I was thinking, you just cannot be serious. That, why there's nothing, therefore we just have no evidence to actually work with. You've not included that. And that was what I thought about that. So I think here as well, although I think I had a difference, I think I went for disclaimer of opinion, because I was thinking, I was that upset, I was thinking, no, I'm not even giving you an opinion. I think they went for something slightly less evil. They went for adverse opinion, I remember. So this is that the financial statements do not give a profit or loss. In a way, I struggled with that a little. I thought that the financial statements are misstated. I just felt that they were so central to the to the account that I was going to give a disclaimer of opinion. I've never seen it before. I think it's a red herring question. I don't think you'll see anything like that. Why would you couldn't have done the audit without the statement of financial the profit or loss? So for me, you see, this is what I was saying. This is where I think we sometimes differ. At the beginning of the audit, you get given a statement of profit or loss and a statement of financial position. If you're not given that information at the beginning, that is part of your work, if you like. So you don't have access to all the information that you need, which is why I went for disclaimer of opinion. But they're saying that, okay, it doesn't, I mean, again, we would all be getting marks because we will be highlighting the key points that this is modified. It is pervasive, if you like. It's just that I have gone for disclaimer of opinion and you have gone for, if you like, you have gone for adverse, if you like. But again, this is not common. This is a slightly off one. I wouldn't really bother so much. But I remember going clearly for me thinking that, because when I read this, I felt that they hadn't given this to me at the beginning. I was thinking, then there's nothing I can do. There's nothing I can do for you. And I think the last one was fair, was pretty straight. But again, like I say, so here we are. This is a major court case that would bankrupt the company if lost. The directors assess and disclose the case as a contingent liability in the accounts, and the auditors agree with the treatment and disclosure. So we are happy with this. You have disclosed. We will create, if you like, a going concern paragraph. So those are the types of things we're likely to see. You know, where things are going well, they want to test your understanding of the going concern paragraph. They want to test your understanding of the emphasis of matter paragraph. So we'll always see that things are going well. That's the kind of variation you'll see. Or we're testing for qualified except for. This one I think was slightly, when it says has neglected, it just feels a bit interesting. What does that even mean? At what point are we neglecting? You know, it seems a bit out of sorts to not include that at all. So yeah, and so let's look at that. So definitely here, you're giving the accounts true and fair. It's an unmodified opinion, but you are just highlighting and bringing to the attention via a going concern, via a going concern. Here we are. Yes, the directors have correctly disclosed. The auditor's opinion will be unmodified. It's true and fair. Additional communication will be, this is, if you can remember this expression, because this is new, because it is new in the way of it's laid out now. Additional communication by including a going, they are a going concern. The problem, interesting, because they've gone for this, it's the court case they've decided to highlight. This could be achieved by including an emphasis of matter paragraph. You can see here, it says alternatively, this is what I went for initially. Alternatively, the auditor may consider the issue a material uncertainty relating to going concern and including a going concern section instead of, you see, so you can see what I'm saying, you know, so I wouldn't concern myself so much about this. I went for going concern naturally, thinking I'll talk about it within going concern and talk about the court case. They've gone for emphasis of matter paragraph, talking about the court case. You know, so it really is a matter of, again, judgment. But the point is that we have brought everyone's attention to the matter, I think is the key point. So it's about crossing that line and knowing what it is. And then really you and I may differ on the final presentation, but you're there, I think, is how we do this. Right, great stuff. There is, I mean, what I'll do next week is that there is a bit on, I think it was on non-profit sort of public sector type organizations, just a little bit of theory on that, go through that. And then we should, yes, be able to start working on some questions like I did last week. I think I gave you, so the first thing we'll do next week is to quickly go through, well, I'll mark your mocks and send them to you. We are now in question mode. So it'll just give me, over the weekend, I'll settle on Monday and settle, and then agree some questions that I can send out to you that we will start working on. In fact, but you should please be working on now. Technically, you should start working on as many. Just start, powering through the text. But we will go back to the beginning in terms of our long case questions for revision and start going through that way and working in class. Natalie, I can see your mic is off. Did you want to say something?
Oh no, that's okay, Owen. No.
Oh, okay, no, it's okay. Sorry, that's fine.
There's no noise now, so I can turn it off.
All right, that's fine. Yeah, so I'll tell you what I think. I think that what might be good. I know you guys are busy. I appreciate that. So that we get through as many questions as we can. If you try and do at least one of the, or maybe two of the questions I give you during the week, so that if you remember how long it took to feedback some of these questions, they're crazy. You could almost like spend like, if you remember, like 45 minutes just feeding back on the question. So imagine the problem is if I gave you 45 minutes to do it in class in our time, and then we fed back, that's almost like half the class or a third of the week. So that we get to do as many questions as possible. I will try and even if you are only writing your notes up on it, really try and do the questions so that our class time is spent on feeding back on the question. It's much more efficient. I mean, of course, we will do a whole questioning. When I say do a question in class, where I will set the question, you'll do it, and then we'll feedback it. So maybe we can try and do that after the break type of thing. So we'll come back, we'll start the class where we are literally feeding back on questions I've given you during the week. Then after the break, I'll give you, if you like, half an hour, to do a question, and then we'll feed back, that kind of thing, so that our time is as efficiently so we can really take advantage of this 6 weeks that we have technically, right, to tie up, and we really nail audit, and you do well. Yeah, any questions?
Ian,
Yes.
sorry, just quickly, it's off the topic of reporting, but I've had a mind blank during the week. So when we're doing the audit risk and the audit response questions, you said there was 5 words you should use to start every response, like for obtain, analyze. I can only think of those 2. What are the other 3? Or
of course. So that was the AEIOU. Was it? Are these the ones?
That's it.
AEIOU. Yes, that's right.
But
But
I
you
couldn't
see,
remember what the other words were.
no worries. The U is really recalculate. The U is recalculate, reperform, analyze, inquire, inspect, observe.
Brilliant. Much appreciated. Thank you.
No worries. That's the kind of your attack into never use the word check.
Yeah, that's it. Yeah.
Just because it's a nice one to kind of run into. Obtain, yes. Where are we? Observe, obtain, observe, and obtain. Obtain is this one where so obtain should always be your first. So you will always say obtain a list of what it is you intend to look at. Another fancy word that they like is cast, like add, if you like. So again, you're right. I think these are your big words. And then once you start doing this, you see that, like, to be honest, once you start writing these down, you get bored of them. When I say bored of them, you just kind of know that, I'm going to be writing this. And again, I want to be careful that we don't peak too early and you get too tired, and then you just want to kind of still be doing, I think, 2 every other day. I think you can do a question every other day. I think that shouldn't tire you. So which technically you could do 3 questions a week, I think, and that should give you, and please, you're typing them. Your exam is a typed exam, and then you can email me them. And it does work. It does matter, because I mean, the class before yours, a couple of the lads who kind of, they understood the theory, but then they noticed that when it actually comes to writing down an answer, sometimes you're like, oh, am I using the right language? And then you'll suddenly notice that after a few kind of marked examples, you're like, okay, now you're writing it's a technical, you're writing in the language. So I think you might actually understand what's going on, but it's really important to actually write an answer and see how far off you are from the mark scheme. Cool, great stuff.
Oh, just
Yes,
quickly,
yes.
you're trying to type so much in the exam, would you get penalised for saying, you say statement of financial position?
Yes.
You just said SFP.
Good point. Good point. I think the best way to do that is at the beginning of if at first you write S or FP and you put you write statement of financial position and in brackets you put SFP and put 2 stars or something at the beginning, and then you carry on with SFP, you're fine.
Right. Okay.
Initially, as long as you initially just state what it is, you're fine. Yes, you're right. There's no point. Yeah. Cool. Great stuff. Awesome. Great stuff, guys. Thank you. And we will carry on as usual next week, Friday.
Brilliant. Much appreciated. Thank you.
No worries.
Everyone.
Yeah, thanks, Ryan.
Thanks,
Thank you,
guys.
Ryan.
No worries. Have a good weekend.
Bye.
Bye.
Bye-bye. Bye-bye.
Bye.
Bye-bye. See you later.